Hello, everybody. I'm happy to welcome you to the session, Scaling Sustainable Infrastructure. My name is Katharina Schneider-Roos. I'm the CEO of the Global Infrastructure Basel Foundation. I would like to ask you again to log in to Slido, because there will be a poll coming up. I'm sure you know how to do that already. The aim of this session is to explore how we can use standardization to help mobilize private investment for sustainable infrastructure, and how this can address why this is critical to ensure a functioning marketplace. It will allow participants to contribute to how we can best develop a set of aligned indicators that capture the sustainability of projects. And the idea for this session came because GIB is leading a collaboration initiative of various sustainability standards in the infrastructure sector. We developed our own standard, the SURE standard for sustainable and resilient infrastructure. And we think by aligning several standards to have one set of aligned indicators would help investors with their decision-making processes. This session will start with a panel discussion, and after the panel discussion, we will have working groups in the corners, but we'll talk about that later. I would like to go to the poll. I think for this session, it's really important to know who is actually in the room. So please poll for whoever you are. I'm just seeing, I hope there's another option too. So we'll see. Can we see the poll already? So I can't see that actually what it says there. We do have, most of you are infrastructure developers actually, which is very interesting. We do have, then I would say a similar amount of standard developers and investors in the room, and no asset managers. So that's good to know. 7% asset managers. I think we can go to the next question, which is, where is the question going? What is the main obstacle for asset managers to adopt ESG considerations? A perception that it will jeopardize returns. Investors do not consider ESG issues financially material. Wow, this is jumping up and down. And there's a lack of reliable, comparable and high-quality ESG information to support investment decisions. That makes me happy, because we can help with that, with the standards. So this is a very interesting result. So with that, I would like to hand over to Robin Haack, who is moderating the panel.
Thank you, Katharina. Just checking, the mic seems to be working. That's good. All right, so as Katharina mentioned, she is the CEO of Global Infrastructure Basel, and her team has evaluated over 100 different infrastructure projects to assign the GIB grading. Then we have Sébastien Solielle, who's the Global Head of Energy Transition and Environment for BNP Paribas, and he has over 17 years of experience in renewable energy, in traditional energies, and then also in the development of strategies to get to the energy transition that we want. And then we have Sachin Vankalas, who is the Director of Sustainability for LuxFlag. So LuxFlag is the Luxembourg fund labeling agency, and Sachin works with investment funds active in responsible and sustainable investing, including ESG investing, microfinance, and impact finance. So thank you, everyone. And the first question would be to you, Katharina. What is sustainable infrastructure?
It took us 3 years to find that out. It took us 3 years and an engagement with like 50 institutions to then find a consensus. And these institutions were from different backgrounds. It was private investment, development banks, WWF, city representatives, FIDIC, like the engineering associations, and representatives from various regions. We had representatives from India, China, France, South Africa. So after 3 years of aligning all these really interesting contents and understandings of what sustainability and resilience means in infrastructure, we came up with 61 criteria, and it was a consensus-based decision. So we're very proud of that. And 2 weeks ago, we became a member of ISIL, which is the umbrella organization of sustainability standards. So this is the next big step we did last year, also joining a community, a standard-setting community.
So would a coal plant that lasts 50 years count as sustainable infrastructure?
That would drop out.
Just making sure. All right. So what is the SURE standard? You've talked a little bit about it, but maybe you could elaborate a little more. How was it developed? And you mentioned the stakeholders, but what was the process? And then what's the outcome? So is it more of a label or a grading, or what does it look like?
So it actually started with we did 5 years of summits on sustainable infrastructure, where we used another tool. We had the GIB grading, where we assessed 200 projects and presented those projects from emerging markets to investors. And while doing that, we understood that we would need a third-party certified standard, a full assurance system to assure investors or that the project actually have an impact. So the SURE criteria, they are ESG based. We heard already ESG is not used anymore, but we actually combine it with the sustainability and resilience aspects. So we can talk about risk reduction on the one side, on the ESG side, but at the same time we have a process within the standard that also shows impact and benefit creation. So with the same tool, the project owner can actually show that the project has been de-risked and has created benefit, and it shows very clearly where these benefits are.
So that's a tool that can be used by the infrastructure developers in the room, or is it you who evaluate their potential developments?
As it is a third-party certified standard, we are not allowed to certify. It's auditors who certify. So it's very transparent. There's very strict rules around that. Very robust.
Great. And then maybe Sachin, what is the role of standards? Now, of course, LuxFlag develops standards and labels, and why does that matter? And maybe you could also go into what LuxFlag is and why it was created.
Thank you, Andrew. LuxFlag stands for Luxembourg Finance Labeling Agency. It's a not-for-profit organization created in Luxembourg, both by public and private side, to award a recognized label, or you may call it as a certification, for investment products which invest in sustainable finance. So not only sustainable infrastructure, but different themes of sustainable finance, including climate finance, ESG, environment, impact investing, microfinance as such. Now, coming back to standards, I mean, we have developed for each of the label which we award to applicant investment funds, we have certain criteria, certain eligibility criteria based on which, as long as they are compliant with those criteria, we award a label for a period of 1 year. Now, not only LuxFlag, but all those standards which are in the market is certain kind of affirmation, certain kind of let's say it's not a guarantee, but it's kind of endorsement by the labeling or standard setting body towards investors, saying that, okay, these labeled funds or these certified funds or these certified projects meet certain criteria. So this is one of the best tool or comparability tool for investors to compare different projects they have. And it also gives, for the project itself, or for the investment fund itself, a good signaling, or it's a kind of a logo, it's kind of a stamp from an independent recognized body. So it gives certain kind of a marketing possibility also for that investment project or for that infrastructure project, which they could that could help to attract more capital.
Okay, I was just going to ask you as a follow-up question why, if I'm a distributor of investment funds, why I should get a label, but that seems to be that's always a good reason to get more investments. But what are the drivers then of sustainable and responsible investing?
In general, I mean, after December 2015, after the COP21, certainly there is a huge political and public attention or awareness towards sustainable finance. If we look at the numbers, or if we look at the volume of investors in general, we will clearly see that millennials play a very important role, and millennials certainly want to know where my money is going to be invested, whether that is creating any positive value, or at the same time whether that is affecting somehow the environment or society as such. So certainly, in my opinion, the public and political awareness is one of the clear, strongest driver for going towards products which are more sustainable and responsible. But in addition to that, certainly, I mean, why not? There is a huge potential to grow. I mean, if we talk about simply climate finance, we speak about trillions. Social microfinance, impact investing, these all different themes have huge potential to grow. Now, the third driver I would also say is more and more regulators are looking at this type of asset class. I mean, you probably are aware of the EU Commission's action plan and following 3 legislative proposals, which are now to be activated or to be considered or to be in function in a couple of years in Europe, which will make asset managers in some sense mandatory to consider certain ESG integration. So these are, I would say, a public political awareness, the growth potential, and the regulatory trends are one of the main or key drivers for more and more growth in sustainable finance. We did in Luxembourg, with the help of Association of Luxembourg Fund Industry, a study of responsible investing in Europe about 2 years ago. We are about to do also next year, and which shows clearly that there is about 30% compounded growth over year to year since for a number of years now on growth of assets in sustainable finance. So certainly we see that this sector is, and one more important thing, when we talk about sustainable finance, it's not only about growing the green industry, it's about greening the growing industry. Because we are not talking only about investing in forest. We are talking about every sector, every industry should be considering certain climate or environmental considerations in their investment processes. And that's why it's very important that we understand it properly in this way.
Mm-hmm. Yeah. So you mentioned the importance of thinking in large numbers, and you mentioned trillions, and of course the commitment of COP21. Now, of course, in the last couple of years, we haven't really seen an increase in terms of what actually arrives, for example, in clean energy projects, right? The last couple of years, it's been pretty stagnant at, say, $300 billion in investments. So, Sébastien, maybe the question to you, what does it take for us to allocate more capital to sustainable infrastructure?
I think that one thing that is very important to scale up the financing of sustainable energy infrastructure is to understand, to be fully aware of what are sustainable energy infrastructure. My point is, because of the fight against climate change, there is an energy transition that is underway, and this energy transition has huge, has significant impacts of the energy infrastructure we have to finance. So for me, the four main characteristics of this energy transition are that this energy transition is low carbon, obviously, decentralized, collective, and digital and dynamic. What does it mean for energy infrastructure? First point, it's low carbon, so it's mostly about renewable energy and energy efficiency. And we know that this kind of projects usually needs financing over quite a long period of time that can go up to 12 to 20 years. And it's it's longer than traditional projects. So we have to adapt the financing tools to be able to finance this kind of long-term projects. So first point. Second point, the energy transition will be decentralized. So it's not any longer about one big energy producer selling the energy it produces to transmission and distribution operators, selling to final users. All this in a very linear and centralized way. It's not this way. Now we have a lot of small players, both so what we call prosumers, that is they both consume and produce, and so it's very interactive, very complex, and they create a lot of small projects with tickets of investment much smaller than traditional projects. And okay, banks and financial institutions are not used to be interested in such small projects. So they have to be now, and so we have to develop new tools to finance as well these small projects. Third characteristic, the energy transition will be collaborative, meaning that there will be many different actors in many different places. So I've just said a word about it. It's not a producer, distributor, and consumer. It will be much more complex. So many actors in many different places. All of these actors need investment. All of these actors will generate revenues. So how can we finance all these actors with the money they need at the moment they need, with the assets they need? So third point on which we have to be innovative. And fourth point, the energy transition will be digital and dynamic. That is that more and more we'll have to adapt supply and demand in a very dynamic way thanks to big data, in artificial intelligence and all these kind of things. Meaning that there will be new actors, actors from IT, from the artificial intelligence, and so they need as well a different kind of financing tools. So the energy transition is underway. It has a big impact on energy projects. So we have to develop new financing tools and think out of the box, just as Pierre Rousseau said a few minutes before.
So historically, it's been, of course, it's been utilities who've been funding massive infrastructure projects. Now it sounds like you're saying that banks will be the ones who are taking the risk to finance a distributed set of energy generating systems. So are banks becoming the new utilities?
I think it will be more complex than this, because utilities are still a role to play, smaller actors as well. So I think that yes, it will be much more multi-actors, much more collaborative, with both energy and money going in many ways, in a less centralized way than before. So before there were utilities irrigating all the whole system. Now we'll have many decentralized actors and with many interactions.
It's not only banks, but other financial institutions also. Sure. And again, one even step higher, not only financial institutions, but financial centers as such. I mean, I can give a clear example of Luxembourg, which has thought through about sustainable investing and financing for green for now number of years. I mean, we have, probably you have heard the largest exchange, green exchange, which was created about 2 years ago, where world's more than 50% green bonds are listed on green exchange. We have International Climate Finance Accelerator, which finances newly created projects around climate finance. So there is a role not only for a group of institutions, but it's more than that as a financial centers and as countries and as a policymakers, so that only we could finance this amount of growth.
Talking about policymakers, what else beyond standardization and what else does it take to reduce the cost of capital? Especially now we're talking about financing, let's say, solar panels for individual retail customers. So what will it take to really finance those 20-year assets, or even like solar or energy efficiency all across the world? I mean, we've heard about the 60% of the building stock still being in place till 2050. What needs to be in place to make that happen?
Yes, we are talking of small projects with many different actors. So the example you are just giving is very interesting. So we need several things. First thing, since they are small projects, it's very important to aggregate these projects in bigger portfolios and to decrease the management cost per project. And for that, a good way is to create a kind of standardization of projects to make each project easier to assess, thanks to common standards, thanks to common metrics, to be able more easily to aggregate, to evaluate and aggregate these projects in bigger assets. And the other thing is there are many actors. So we have to create a trust framework between all these actors so that the financing guys can easily easily trust the infrastructure guy. So we have to develop a way, some kind of standards, some kind of metrics, some kind of verification tools, so that each individual actor has a big trust in the whole system. Otherwise, it won't work, and there won't be any common building in this direction.
I just wanted to bring the discussion back to sustainable infrastructure, because I think as the discussion yesterday also showed, we have to combine it with other topics like social topics and biodiversity and. So, and I think it's also really worthwhile to look at other sectors, infrastructure sectors, to include transportation. So I would like to broaden the discussion again, also for example, also for the next step when we discuss in the working groups.
Yeah, and we're going to open it up now to the audience as well. We'll be making it more interactive. So we're going to split up in 4 different groups, and one of them is going to be about instruments. One of them is going to be about renewable energy. And then one is going to be about standards, and then one about data and liquidity. And so we're going to be in different parts of the room. And so you'll see the different signs that are in the corners. And we'll be having a standing discussion so that we can all get some energy back. So and then we'll come back after 15 minutes and just do a recap of the individual discussions we've had in our groups. So thank you everyone for participating. So we'll start with standards. What were the main themes or findings in your discussion?
So many findings. Trying to figure out. I think one discussion was about how to assess or the discrepancy about assessing projects on the project level, on the asset level, and on the portfolio level. I think there needs to be an alignment. One major barrier was seen in education on sustainability issues in the infrastructure sector. Then, yeah, the question that there's no unified taxonomy but we're trying to help with that, to bring all these standards together. I think that's really something we should look into. And then it was about the uptake of voluntary standards, that the value they create should be very clear, and we're still struggling with that.
All right, so quite challenging, and that was also the theme of our discussion. It's challenging. So we talked about the illiquidity premium, which basically adds financing costs of around 2% per year, which is very, very, let's say, harmful for project developers when you're talking about a 20-year, for example, solar asset. And so the question was, can we try to make these assets liquid by, for example, pooling them together and then creating real-time data feeds to make investors comfortable? The main concern from investors one of the main concerns from investors that we've heard is, well, first of all, it's really hard to offer liquidity on illiquid assets. So you could have a two-tiered structure, you could offer several exit points, but it's really hard to structure and insure. And then even if you do have liquidity in the overarching fund level, right, when the markets go down, people will probably pull their assets out as well, and then you have low performance. And again, sometimes investors apparently actually like the lack of noise from liquidity, because then you don't have to report poor performance. So the unfortunate thing is that if we're looking at short-term performance measures, that can really harm sustainable investing. So I think the conclusion there was, like, it's really important. We didn't draw that specifically, but the conclusion for me there was long-term indicators are important, long-term targets, and also the other finding was that I was too ambitious with grouping data and liquidity together. Maybe they're less related than I would wish them to be. So, yeah.
In our group, we discussed mainly two points, both of them very interesting. The first one was what kind of environmental, social, and governance criteria were relevant beyond just energy and CO2 when it comes to investing in energy projects. So yes, we discussed on the fact that sometimes there are synergies between energy, CO2, and other impacts. Sometimes there are trade-offs, and we have to deal with it and to assess all things in a coherent way. So it was the first point. Second point, it was renewable energy projects are often small projects. How can we group them together in coherent portfolios? So it needs to make many people discuss together. So that means that they need to develop a common language with standards, with metrics, with a common purpose. And yes, that often it's necessary, but it's often tricky, and it's very interesting.
Question which we discussed was what is the role of standards and certifications and these labels? Do they play any important role? And our common feedback from the participant was yes, mainly because standards and labels help to set the bar, maybe not high, maybe not low, but at least set the bar. So that helps in benchmarking. Second, there was also a comment mentioned about access to funding. So if you follow certain type of standards, or if you have certain kind of certification or label, that certainly can be played as a marketing tool to access or mobilize more funding. So be it for buildings, I mean, if you have a green building or if you have certification like BREEAM, that certainly helps investors to understand certain qualities or characteristics of that particular building. So that was about standards and labels. Second thing which we discussed was it's all fine about labels, standards, and sustainability as such, but integrating sustainability in your process, be it for investment process for investors, but also for companies or infrastructure projects, that incurs certain amount of cost. Is that cost justifiable? Does it pay And our understanding was, yes, it pays, maybe not immediately, maybe not in shorter term, but in longer, longer term, that certainly has a positive impact as such.